What's up, everyone? My name's Robbie. This is Robbie and Manil, and today we're talking about how my stock screener killed the S&P 500. So exactly 1 year ago today, March 3rd of 2021, I ran a stock screener. I picked 40 different stocks, and today we're going over those results. I made a video about this whole thing. I posted that a year ago tomorrow. The video is called, "Is This the Secret Best Stock Screener for Massive Growth?" In that video, I went over how I got the idea to run the screener, where I got the information, and how to actually run it. So if you do want to watch this video, I will leave a link in the description below. So we'll go over my results, how I actually ran the screener, and a little bit of information about it, just in case you're interested. So let's go ahead and let's get this thing started. Alright, so let's go ahead and get started, and I want to just jump into this and show you my actual results from this stock screener. So as you can see here, we have a spreadsheet that's actually been linked in the description of that video I just told you about. This has been there the whole time since I put that video out, and I still have it up there in the description, but what I did was I stopped the updates of the stock prices. So basically this is going to stay the same forever. It's not going to update and show you like any new price information. Basically, I just wanted to make sure that we understand that this is going to be a 1 year stock screener. You run it, you hold it a year, you sell everything, you run it again. So it's a very important part to understand about this screener. If you ever do try to run it, you don't hold this thing for a long period of time. You run it every year and you continuously turn over the whole portfolio every year. So this screener actually had 40 different stocks in it, and as you can see in the screener, not every single stock outperformed, but the aggregate total average of all of these stocks combined did a really good job. Now the very first stock we have here is called Antero Resources Corp, and it had a 155% gain in just 1 year, so obviously that's pretty good. But then the very next stock, Desktop Metal Inc., actually had a negative 79% return. So this screener isn't for just finding specific stocks and only buying one. You're supposed to find a basket of these stocks and buy the entire basket. You can't figure out which of these stocks is going to be really good by just going through the screener. You have to buy them all together. That's how this works. So the best return in this portfolio that I ran was Alcoa, which had a 200% rate of return over the past 1 year. And the worst return was the one I just mentioned, Desktop Metal, with a negative 79.6% return, which is abysmal. Over here you can see the price of the S&P 500, which is actually represented through the ETF SPY. And so when I added all these stocks, SPY was 386.54, and today it's 437.89. So it had a 13.28% return, which is a really good return, of course, for the S&P 500. That's over probably the average over the past 20 years. But when it comes to the aggregate of this portfolio of stocks, it definitely beat the 13.28% of the S&P 500. Now, before I show you the exact number of outperformance, I kind of want to show you real quick how this was set up and what this actually screens for. So I actually got this idea from a website called valuesignals.com. I read this abstract that they posted, and valuesignals.com, by the way, has its own stock screener. And they have this abstract of a backtest that they ran of a bunch of different factors. Some of the different factors they used included earnings yield, free cash flow yield, price to book, price to sales, Piotrowski F-score. So they ran all of these different factors and saw which of these stocks performed the best given the different factors when they backtested it. Now they did two different things. They did single factors, like they just picked one thing, let's say the price to book ratio, for example. How did just buying stocks based on a low price to book ratio perform? And they also did it based on two different factors. So they combined two factors. For example, maybe PE ratio with Piotrowski F-score. So in terms of the single factors, they basically lumped these into different categories. So there's valuation, fundamental, momentum, and then the hybrid. The best performing ones in the valuation were it was earnings yield, which is just the inverse of the price to earnings ratio, and the price to book ratio. For fundamental, none of them did very well. Return on invested capital, return on assets, Piotrowski F-score, none of them did amazing. They all had some problems. There were no linear returns for Piotrowski F-score. Result was weak. In terms of momentum, though, they did have something that really outperformed, and that was price index for 6 months, which is basically saying the stocks that had the highest returns over the past 6 months did the best the next year. And essentially what that's telling us is momentum stocks did really well. And so these single factors are great by their own. So for example, for just the single factor, if you had just bought the 6-month price index, so the stocks that had the highest rates of return over the past 6 months, this is the first quintile of those stocks. You would have had, if you bought the small cap stocks, you've had a 285% return, with mid cap stocks 248% return, and large cap 150% return over a period from around 1999 to 2011. And by the way, during this time period in Europe, the stock market was basically flat. So it definitely outperformed by a huge margin. But it actually gets even better when you combine factors together. And actually the one that worked the best was when you combine the 6-month price index with the price to book ratio. So as you can see in this chart, this is both of the factors combined and how the rates of returns were over that same period. So what they did was they said for 6-month price index, so the stocks that had the best rate of returns, what if we took the top 20% of those stocks? And then we sort those stocks by these different factors. Well, the best one was the price to book ratio, 1,157% over this time period by investing in those different stocks. So I thought to myself, well, why don't I try to run this in the US and run it, modern day and see how it goes? So I actually did it. I just, of course, you just looked at the spreadsheet that I made last year, and I'm actually really happy with the results. And I think going forward, I might basically incorporate this into my investment strategy, my investment portfolio. So, okay, let's go ahead and let's show you the exact returns for these. So this is it right here. So basically this screener overperformed the S&P 500 by 20 percentage points. So the stock screener's return was 33.29%, which is an amazing return, especially when the stock market actually did pretty well. And it was actually not that easy to get a very high return like this to beat the market last year. A lot of companies towards the end of the year really got creamed. I'm actually exceptionally happy with this because of that. So as you can see, the S&P 500 had a 13.28% return. That's why 20 percentage points outperformance. If you could do this every year, you would have an amazing return. Of course, I'm not expecting that to happen every single year, but I'm just happy with the results of this so far. Now, because the market was so kind of crazy this year, and while the general market did well because Microsoft and Apple and those giant companies, their large cap and quality companies did very well, a lot of people really got hurt in growth stocks that had really high valuations. We're talking about stocks like Peleton, down almost 90% since January of 2021. And also stocks like Nio, where everyone was going nuts about YouTube videos about Nio, and it's down 73% since that time period. So one of the things I'm actually happy about in the screener is that it did not have any stocks like Nio, like Peloton, these huge growth names that were really hyped up. They didn't make it into the screener. And why do you think that is? Well, because it uses two different factors. Of course, one is momentum, and it definitely, these stocks at that time probably would have fallen into the screener given how much momentum was behind them at the time. But the other factor was the one that got rid of those different types of growth hype stocks, and that was the price to book ratio. By having low price to book ratio stocks, we got rid of those really high valuationed companies. And that's why the screener is so interesting. It's a blend of both momentum but also value, because it uses momentum as an indicator and it uses low price to book, which is a value signal. So anyway, at the end of the day, I'm really happy with the results of this one. I hope it works going forward. I'm going to do a little test of it with some money, and we'll see how it goes for the next year, of course. And I know you probably want to see how the results go over the next year. So yes, I'm going to be linking the results in a Google spreadsheet that you can access in the description below. These are the 40 different stocks that this screener just screened out for me. I just ran it. You have some interesting stocks in here, of course, CVS, Cigna, Ford Motor. So some interesting stocks, and then some stocks that I've honestly never heard of before. So that's all I got for this one. So let me know if you like this video. Maybe going forward, if you want to see how I might use this in a portfolio of different strategies, let me know. Maybe I can make a video on that. And if you liked it, hit that like button, subscribe to see future content like this. And there's another video. It's coming up on the end screen right now.